Let's remind ourselves of the question: how do you get rich while the stock market is crashing? The answer is actually simple: by not panicking. But to stay calm, there are a few things you need to know. Imagine this. You wake up in the morning, make your coffee, glance at your phone, and bam, your portfolio is blood red. Not just red, nuclear red. As if the market developed a personal grudge against you while you were sleeping. The headlines are screaming, recession is coming, crash ahead, investors in full panic. And you're thinking, great, so today is my cry in the shower day. But stop, take a deep breath. Because here's a brutal truth. Stock market crashes are the periods when some of the biggest fortunes in history were built. Yes, you heard that right. The real finance ninjas are born during crashes. While everyone else is panicking, if you learn to stay cool and rational, this roller coaster can actually make you money. Today I'm going to show you how not to panic when the market is falling. And no, not in a boring professor tone. This is 13-minute finance style. Simple, fun, and straightforward. First section, why do stock markets crash? The stock market crashes for three main reasons. You need to understand these because the reason for the crash shapes how you can profit from it. 1. Bubble bursting, the end of the hype. A bubble is basically this. People turn off their logic and crank FOMO, fear of missing out, to maximum level. That's exactly what happened in the dot-com bubble around 2000. Investors were throwing money at any company with .com in its name. Zero profits, zero real business, but stock prices were mooning. Hype inflates the bubble, reality pops it. And when it pops, prices roll down like a snowball off a cliff. 2. Economic problems, when the slowdown is inevitable. Inflation goes up, interest rates go up, consumer spending goes down. Companies earn less, investors get scared, people start selling. When the real economy gets sick, the stock market naturally coughs. 3. Black swan events, the surprise punch. Pandemics, wars, terrorism, massive scandals, these are the things almost nobody sees coming. We saw a perfect example in 2020. In just about 5 weeks, markets dropped over 30%. These three are basically the mothers of all crashes. Second section, are crashes normal? Yes, and often necessary. If you can't accept this, don't be an investor. The stock market grows through volatility. If it never went down, it could never go up in a healthy way. The market moves in cycles. Cycle types: pullback, correction, bear market, crash. Drop size: pullback 5 to 10%, correction 10 to 20%, bear market 20 to 40%, crash 40% plus. Frequency: pullback almost every year, correction every 1 to 2 years, bear market roughly every approximately 5 years, crash around every 10 to 20 years. You know what they all have in common? They all came back. 1973 oil shock, market dropped approximately 50%, took 7 to 10 years to recover. 1987 Black Monday, approximately 22% drop in one day, recovered in about 2 years. 2008 financial crisis, approximately 50% drop, recovered in about 4 years. 2020 COVID crash, approximately 30% drop, recovered in around 4 months. So who wins? Not the ones who sell, the ones who stay and hold. How do you get rich during a crash? This is the heart of the whole thing. If you don't understand this part, you'll be a low-level investor forever. If you do understand it, then every crash becomes your wealth season. 1. Don't panic sell, the biggest sin. Selling just because your portfolio is red is like trying to escape a fire by pouring gasoline on yourself. If you're selling a stock just because it dropped, what you're really saying is, I make decisions with my emotions, not my brain. But good companies recover from downturns. Historically, the S&P 500 has fallen many times, but always recovered and gone on to new highs. In short, as long as you don't sell, your loss is temporary. The moment you sell, your loss becomes permanent. 2. Don't try to predict the bottom. Stupidity level, hard mode. I'm going to buy the exact bottom. No, you're not. Even professionals with billions of dollars and teams of analysts can't do that consistently. The real solution? DCA, dollar cost averaging. You invest a fixed amount at regular currents. When prices are high, you buy fewer shares. When prices are low, you buy more shares. That means you don't need to time the bottom. The strategy automatically buys the dips for you. 3. Don't buy garbage just because it's cheap, the graveyard stocks. Not every falling stock is an opportunity. Some never come back. Some go bankrupt. Some stay at the bottom and rot for years. If everything that crashed was a bargain, the Titanic would have been sold as a lightly used cruise ship. What you should look for is low debt, strong cash flow, a profitable business model, a growing or promising industry, solid management. Think about Amazon. It went from around $90 down to below $40. That wasn't a warning sign. That was a gift. The people who bought at those scary levels are the ones who made real money when it skyrocketed later. 4. Diversify. People who put all their eggs in one basket regret it. One single stock equals gambling. One single sector equals high risk. A real investor spreads capital across technology, healthcare, consumer sectors, energy, international markets, bonds in some strategies. ETFs are basically a ready-made diversification package. Instead of taking stupid risk on one name, you take structured risk across many names. 5. Don't let FOMO control you. The crowd is not always right. Mass psychology is dangerous. The news loves to amplify panic and fear because fear gets clicks. But remember what Warren Buffett said: never invest in a business you do not understand. And let's add this: if you blindly follow the herd, you will share the herd's fate. 6. Cash is king. During crashes, opportunities rain from the sky. Crash periods are basically a massive discount season. But if you have no cash, those discounts mean nothing. That's why before a crash hits, you want to have some cash on the side, short-term safe instruments, high-yield savings, or similar options, depending on your country. When the crash hits, strong companies often trade at 20 to 50% off. And that can translate to huge long-term wealth.
Now we are at Article 7 of How Do You Get Rich During a Crash?
The most important human factor: psychology. In the stock market, what determines wealth is not just technical knowledge. It's emotional control. Everyone claims to be a long-term investor when the market is going up. The real test comes when the market is falling. During a downturn, those who panic lose. Those who stay calm win. Those who buy quality at a discount build wealth. So let me ask you this. When the next crash comes, which side do you want to be on? On the side of those who panic and sell? Or on the side of those who stay calm and collect opportunities? If you want to be on the right side, hit the like button, subscribe to the channel, and turn on notifications. And if you want more videos like this, drop a comment below. What scares you the most about the stock market? Because upcoming videos will be packed with strategies designed to protect you and help you grow during these exact periods. Let's keep going. Now we are at 4th section, turning theory into an actual game plan. Up to this point, everything we talked about is mindset and principles. Now I want to turn this into a practical checklist you can literally screenshot and use during the next crash. Because if you don't translate ideas into action, nothing changes. Step 1. Build your crash playbook before things go wrong. The worst time to write your rules is when you're already panicking. It's like trying to learn how to swim while you're drowning. Right now, while you're calm, decide. What percentage drop will you tolerate without selling? At what levels will you add more to your favorite positions? How much cash do you want ready for a crash? Write these down, not in your head, on paper, or in your notes app. Because in a crash, your emotions will lie to you, but your written plan won't. Step 2. Separate your emergency money from your investment money. One huge reason people panic is this: they're investing the same money they need for rent, bills, or groceries. Rule: emergency fund first, investments second. If your basic life is not secured, every market dip will feel like a life or death situation. But if you have 3 to 6 months of expenses set aside, the red candles hurt your ego, not your survival. Step 3. Create a short watch list of crash targets. You know how people stalk flight prices and wait for discounts to book that dream trip? You should be doing the same thing with quality companies. Make a short list of the top 5 to 10 companies or ETFs you believe in long-term, why you believe in them in one sentence each, a rough price range where they become on sale for you. That way, when a crash hits, you're not asking, what do I buy? What's happening? You're saying, okay, item 1 on my list just hit my target range. Time to DCA. Step 4. Automate whatever you can. The more you rely on willpower, the more your emotions will sabotage you. Automation is how you protect yourself from yourself. Set up automatic, recurring investments into your main ETFs or funds. That way, even if your brain is freaking out, your system keeps buying small chunks on schedule. Think of it as your robot version quietly making rational decisions, while your human version is refreshing the red portfolio every 14 seconds. Step 5. Learn from other people's mistakes, not just your own. Crashes create 2 types of stories: people who lost everything, people who built wealth quietly. Pay attention to those stories. Who used too much leverage? Who chased meme stocks at the top? Who bought solid companies, held on, and came out stronger? You don't have enough lifetimes to make every mistake yourself, so steal the lessons from others for free. Finally, remember this is a long game. A crash feels huge when you're in the middle of it, but if you zoom out 10, 20, 30 years on any major index, crashes look like little bumps on an upward trend. Short-term, the market is a voting machine. Long-term, it's a weighing machine. In the short term, emotions, headlines, and fear vote on prices. In the long term, real value and real earnings win. Your job is simple: survive the noise, stick to your plan, use crashes as discounts, not doom signals. Conclusion. The summary formula for getting rich during stock market crashes. Stock market crashes look scary, but in reality, they're often the true starting point of long-term wealth. While everyone is running away, if you stay calm, you win. The formula is simple: no panic, no emotional selling, yes to DCA, yes to quality companies, yes to diversification, yes to emergency cash, yes to strong psychology. When a crash hits, people start shouting, "This time it's over. Everything is going to zero." But history keeps saying the same thing. After every major drop, there has always been another rise. Short-term fear destroys wealth. Long-term thinking builds it. Closing. The next time the market crashes, you won't panic, because now you understand how the game is actually played. See you in the next video, and remember, wealth is often born in the crash.